Hello and welcome to our webinar, which is on residential property tax and what you need to know in 2024. My name is Kirk Vaughan. I'm a Client Services Director at Knights Low, and I've got my colleague with me, Michael Welsh, who is a manager at Knights Low. We both have a number of clients that are both property investors or property developers, and obviously they want to keep up to date with any changes in taxation. There have been quite a few tax changes in recent times. We're just going to run through some of the upcoming changes over the next sort of 12 months or so today, as well as anything else that we think you should really be aware of. There is a Q&A section on your screen, so if you've got any questions throughout the webinar, feel free to add any questions, send them through to us, and we will try and have a bit of time at the end of the webinar just to run through those as well. This is a bit of an agenda of what we're looking to cover today. So we're going to start off looking at making tax digital for income tax purposes. That's going to change quite significantly the way that you report information to HMRC. So we need to make sure we're ready for that and prepare for that. We've also got capital gains tax and some changes that have happened when you're selling or disposing of properties. Question we often get asked is about property incorporation. So we're going to be talking through that and seeing what the advantages and disadvantages of setting up a company for your property businesses are. And we'll also look at inheritance tax planning, which is becoming more of a problem for property investors due to the value of property prices and things like that as well. And then at the end, we're just going to touch on furnished holiday lets and the changes happening there, and then a few other useful reliefs at the end of the presentation as well. So I will pass you across to Michael Welsh, who will run through making tax digital and what we need to be aware of.
Thank you, Kirk. Morning, everyone. So MTD for income tax self-assessment, otherwise known as MTD for ITSA. What a lovely name. As I'm sure you're all aware, MTD is not something new. MTD was first introduced back in 2019 for all businesses over the VAT threshold. And then since April 2022, all VAT registered businesses were mandated to join MTD. Now, HMRC have their sights on everybody else. Well, almost, as we'll see. So HMRC had planned to extend MTD to ITSA from April 2024, but this has now been postponed to 2026. Do I think it will be delayed again? Probably not. We are quite close to it now, so I can't imagine it being delayed again. Is there a chance that HMRC will scrap it altogether? A question I often get asked. No, I really don't think they will. It's the revenue's belief that bringing everybody into making tax digital will reduce error and effectively bring in billions of pounds, they believe. How, I don't know. But apparently the tax gap, so the amount of tax that is due but goes unpaid for self-assessment, amounts to around £5 billion. So they're hoping to get their hands on some of that. So who will be affected? Well, there's ultimately a phasing in. From April 2026, it'll apply to all people with businesses or property income more than £50,000. HMRC believes this will bring in around 780,000 people into making tax digital. Then the following year, so from April 2027, those earning between 30,000 and 50,000 will be mandated into making tax digital. Again, the revenue believe this will bring in a further 970,000 people. How they're going to cope and their systems, who knows, hey? But what about everybody else? Well, the autumn statement back in 2023 actually said that currently they're not looking at anybody below £30,000. However, I'm sure this will be kept under constant review and everybody will probably be brought in eventually. But I suppose as and when they trial it and see how it goes, we will know better. However, for any of you that do want to voluntarily participate before your staging date, you are more than welcome to. So the question is, what do you need to do? ultimately, this is still a moving target. HMRC are currently doing trials, so they're seeing what work and what doesn't. And even as recent as the autumn statement, they actually removed one of their initial requirements, that being the end of year period statement. But we do have a fair idea of what will be expected. So what is to be expected is for you guys to keep your accounting records electronically. That's either using a piece of software or a spreadsheet. How long a spreadsheet will be allowed, we don't know, but they are currently allowing spreadsheets. You're then meant to file quarterly returns to HMRC, which includes details of your income and expenditure. And then at the end, you'll be required to make a final declaration. This final declaration is basically your tax return that you're used to now. It'll have the same deadline of the 31st of January following the tax year, and it will bring together all sources of income and information, all MTD income and all other non-MTD income, such as dividends, interest, allowances, and reliefs. But obviously, as we get further and closer to the line, there will be increased updates and guidance likely to be issued. So watch this space. What happens if you fail to submit on time? There will undoubtedly be penalties, but it's probably something to worry about later on down the line. The Revenue have recently changed their penalty regime for VAT. So, and we're pretty sure it will follow the same suit, which will mean that it's a points-based system. So every time you fail to submit something, you'll get points, and then a certain amount of points will then eventually trigger a penalty. Finally, you'll have to use HMRC compliance software for your bookkeeping and your quarterly submissions. There are obviously lots of options out there. I'm sure some of you are already using them, but if you haven't, you've probably already heard of them. The likes of Xero, Sage, QuickBooks, and we can always help you to choose which software you need. So just ask, basically. And at the end of the day, I think the software will do the worrying with regards to compliance. So it's just about finding one that you're comfortable to use, really. So time to act, absolutely. It's crucial to be prepared. For anyone that's not in Making Tax Digital at the moment, it will probably mean a couple of changes. You're probably used to keeping manual records, so that will change now to digital records. And it will probably mean more regular bookkeeping because you'll have these deadlines of the quarterly submissions. The thing is, we are always here to help you. We have helped hundreds of businesses, haven't we, Kirk, over the years for MTD, for VAT. So, as I say, any questions, you've only got to ask.
Thank you, Michael. And yeah, you're quite right. These changes are going to impact a lot of people. So I think the sooner you can get moved across to compliance software, these people that are going to be caught by these rules, the better. Moving on to capital gains tax, there have been a few changes to the way that residential properties are taxed, which apply from April 2024. But before we get into those changes, in terms of when we will be seeing this tax liability, if you like, so capital gains tax applies when an asset is disposed of. That might not necessarily be when you sell the property. Obviously, selling the property will give rise to a capital gains tax event, and there may be tax payable on the back of that if there is a gain. If you give away property as well, so even though you've not received any proceeds, for tax purposes, it will be treated as though you have sold that property at its market value, and therefore that may also give rise to a capital gain. That's unless you're giving the property away to your spouse. There are special rules, which means that the property is transferred on a no gain, no loss basis. And essentially, that just means that there is no gain that crystallizes at the point of transferring the property to your spouse. It's treated as though the property is transferred to your spouse at your tax cost. So, yeah, giving away or transferring ownership will also be a CGT event that we need to think about. Swapping property. So this may be where potentially you've got joint ownership of two properties and you both have different plans, maybe in terms of what you're looking to do with the property. So if you swap half a share of the property each for consideration of the other half of the property, then that is still a market value disposal for capital gains tax. And again, we need to look at the capital gains tax position of that transfer. And then the final one we've just got here is if you receive compensation for a property. So it might be insurance compensation because the property has been damaged maybe by fire or flood or something like that. Or if someone's got some rights maybe to use part of the garden or the property, then those proceeds are subject to capital gains tax because effectively you're diminishing the value of that property and therefore it's a disposable capital gains tax event. So that's when we're looking at when we're talking about capital gains tax. They're the kind of events we're looking for. So what are the changes from April 2024? Well, the capital gains tax rates for residential property, as much as the gain falls into your basic rate band of tax, the gain is taxed at 18%. That's not changing. That has been the case for a few years now. But what we have got is that the higher rate of capital gains tax, that has been reduced from 28% to 24% in April 2024. So arguably now is a good time to dispose of residential property because we've got a lower, higher rate tax charge on those gains than what we have had for the last few years. So that's well worth thinking about. Every taxpayer has a tax-free annual exempt amount, which is the amount of a gain which is tax-free every year. So at the minute, that gain, that allowance is being reduced to £3,000. It was £6,000 in the 23-24 tax year, and it was just over £12,000 before that. So in the last few years, that tax allowance has reduced quite significantly. This has impacted quite a bit of planning where people have put things into place to benefit or utilize this allowance. And what we were seeing quite a lot of previously was that if someone had a property that they want to pass down to, say, their children, they would gradually gift the property to their children to use up that allowance, which when it was £12,000 a year, so that you could gift more of a property every year and only realise a gain of £12,000, which would mean there'd be no tax to pay. The reduction in this allowance now to £3,000 almost makes that planning not worthwhile doing because the costs of implementing it in terms of legal fees, accountancy fees, makes it not worthwhile using the allowance anymore. So that has restricted quite a bit of planning that can be done around gifting property piecemeal. The only other thing I would add is that we have obviously had a recent government change. We've now got a Labour government. We've had no confirmation in relation to what's going to happen to capital gains tax rates going forward. They've been fairly silent on it. There has been some speculation that capital gains tax rates may increase in the future. The natural first point for them to do that, I think, would be the autumn statement in a few months' time. So I know I've certainly got some clients that are looking at whether it's worth realizing any capital gains now in the next month or two to benefit from the current rates, because I think it's widely anticipated that rates will probably only go down, only go up. They're not likely to go down. I nearly got that the wrong way around, didn't I? So, but yeah, so do we want to benefit from the current rates of 18% and 24% now? That might be more favorable than what we might be looking at in the future. In terms of the reporting side of things, for the last few years now, if you've got the disposal of residential property, and it is just residential property, not all property, and you've got tax to pay, so you've got a gain which isn't covered by the CGT allowance, or isn't covered by losses, or isn't covered by principal private residence relief, so there is actually tax payable, there is a need to complete a return to HMRC within 60 days of completion, and that tax must also be paid within 60 days of completion. If you don't file the return and pay the tax within 60 days, then there are penalties and interest that will apply. So that's just something to be aware of, that when the property has been sold, it's important to arrange for this to be done shortly afterwards. Otherwise, it's unlikely that you're going to be able to meet that deadline. Just also to say that even though you're doing this capital gains tax report, if you complete a end of year personal tax return, there is also a need to complete or add the disposal on your tax return as well. So just remember to, even though you've done the return, make sure it's in your year-end tax return as well.
You don't get taxed twice though.
No, yeah, you're taxed once, but it's just to confirm the level of taxes payable on that gain. Quite right.
Right, now this is a question I think we get asked a lot, isn't it, Kirk?
Yeah.
Should I be running a property portfolio through a limited company? And it might seem a bit of a cop-out answer, but it's incredibly subjective and everyone's situation is very, very different. So, however, let's have a quick look at some of the benefits of running a property portfolio through a limited company. So the top one is you get full relief available for mortgage and finance costs. If you own a property personally, then you only get relief on your mortgage interest at a maximum rate of 20%. So you've got your property income, you take off your mortgage interest to get a profit in the company, that amount's taxed. In you personally, you'll only get a 20% relief on that mortgage interest. You can, as Kirk was talking about, for inheritance tax or other reasons, you can give shares each year from your company to kind of the next generation or pass it on to whoever you want to. I'll do this slightly out of order, but in a company's taxed on the profits that it makes, and this is ring-fenced at a maximum rate of 25%. You, as an individual, will then only pay tax on that income that you take out of the company. So whereas if a rental property was in your own name, you would be taxed on all the profits of that rental property, could be at 40, 45% if you're a higher rate taxpayer. That tax is basically ring-fenced at 25%, and then you can draw out the money, hopefully at a lower rate of tax through dividends, as it says on number 3 there, than income. And it also means you can draw what you actually need rather than paying tax on everything. Another thing you can have in a company is different class of shares. So shares can hold different voting rights and different dividend rights. So rather than paying Class A shares a dividend, you could pay Class B shares a dividend. So that's quite handy if you've got a family-run business where you've got the mum and dad that still want to have the control and the ownership, but then you can pass the income through to your children. And I think that covers all of them on there. But the problem is there are also quite a few pitfalls. And if you don't know about them, it could prove to be incredibly costly. The biggest problem is if you've owned a property for a number of years personally, in order to put it into the company, there's potential that there'll be a capital gain on that sale. As Kirk was just talking about, you basically are selling your property to a company. So at that point, that crystallises a gain on the value, the market value at that date of sale. So if you've owned a property 10, 20 years, there could be an incredible gain on that property, which you will then have to pay tax on, but you're not getting any consideration for it. So you've got to find the money for the tax. Similarly, you'll also have to pay stamp duty land tax for selling that property to the company, because again, you're selling it to a third party, a separate individual. So if you've already paid stamp duty land tax personally, you're then paying it twice. There are also other taxes, such as annual tax on envelope dwellings. Again, what a mouthful. But the beauty is it doesn't really affect rental properties, but it's something to be worth knowing about. It's to catch companies owning residential properties. And if they're worth over £500,000, then basically you have to report it every year. And if there's any tax due, then you have to pay that as well. So the big question is, should you run your rental portfolio through a company? as I said, it's incredibly subjective. And the most important thing is that you take advice. It's incredibly important to have the correct structure from the outset, because as you can see, it's very costly to go from moving your property from one to the other. There will be a crystallization of some tax that's due. However, at the end of the day, everyone is different, and it may be worth, in your situation, your scenario, paying those extra tax charges, certainly if you've got a significant portfolio, and there are also additional reliefs available. So again, it's something that if you really do want to know about, we can have a sit down conversation and talk about, because as I say, everyone's different. There's also additional costs of running a company. Our fees are more, aren't they? There's additional admin costs of running a company. So unfortunately, it's just not a straightforward answer. And we're obviously here if you've got a question or want to know any more.
Yeah, no, thank you, Michael. I think you're right. It's a case by case basis, isn't it? There's not a one answer fits all on that one. It does depend on the business and their setup as to what the best route is.
I wish there
Absolutely.
was sometimes.
Make our life a lot
It
easier.
would.
Um, okay, so moving on to property and inheritance tax. Property prices have gone up a lot in, not so much in the last few years, but certainly if you look back longer beyond that, property prices are now quite high. And we typically find that if we've got a client who owns a house and rental property or rental properties, then inheritance tax is something that is an issue and needs to be thought about and planned against. And it is difficult with properties because of the tax charges that apply to properties. So capital gains tax, inheritance tax, stamp duty, land tax, things like that. So just before I get into some planning options, in terms of a quick recap, in terms of what inheritance tax is. So inheritance tax is taxed at the main rate at 40% above your available nil rate band. The nil rate band starts at £325,000, but it effectively increases to £500,000. So you get an extra £175,000 if you qualify for the residence nil rate band. Now, the residence nil rate band applies if your will passes your home down to your descendants. So that might be your children, your stepchildren, or foster children. And as long as your estate is under £2 million and you pass your home down to your descendants, you qualify for that extra residence nil rate band. So that means that every person has a maximum nil rate band of £500,000. Or if you're a married couple, then you've got an effective nil rate band combined of £1 million. So that's kind of like the maximum tax-free amount you can have by using up your nil rate band. I mean, this webinar is focused really on residential properties. Commercial properties, though, can sometimes benefit from business property relief, which means they're not subject to inheritance tax in the same way, but only if you're using that business in your trade. But residential properties don't qualify for any business property relief. So if you've got buy-to-lets, and even if you've got furnished holiday lets, which can be treated as trading for some purposes, it's very rare for a furnished holiday let to qualify for business property relief because you need to provide a lot more services than your typical furnished holiday let business does. So yeah, again, property businesses will often have inheritance tax issues. Some simple planning is that you can gift properties or shares in a property business or company to your children, let's say, or to your chosen beneficiaries. That can be inheritance tax free as long as you survive 7 years from the date you're making the gift. But the complication comes that very often when you're giving either shares in a property business or the property and you're gifting the property itself, then there may be capital gains tax payable because it is treated as a market value disposal, like we touched on earlier. There could also be stamp duty land tax payable if there's any borrowing on the property, like a mortgage or anything like that, or if you receive any consideration for the sale of the property. So that is inheritance tax. We are seeing more people with an inheritance tax liability these days. So what can you do to try and plan against it? And same as what we were saying before, it's not a one answer fits all kind of situation, unfortunately. It does depend on a number of factors, but here's some options that may well be applicable, hopefully, to your circumstances. But the first most important thing is considering the structure when setting up the property business. Like we said earlier, property is very inflexible to move things around after you've acquired it. You've got stamp duty, land tax problems, and you've got capital gains tax problems, as well as the cost of actually moving the property as well. So getting that structure correct from the outset is really, really important. And when we're looking at inheritance tax in particular, we're kind of thinking, well, if you've got a property company, then would it be beneficial to have some of those shares, therefore some of the ownership outside of mother and father's estate, for example? Could we get the children to own some of the shares, or maybe a trust to own some of the shares on their behalf? Obviously, the older you get, the more valuable that becomes, I suppose. So that's a consideration. There are tax implications on giving properties or shares in the company to children if they're minors. So that just needs a little bit of consideration as well. We can't just give all the property to our children. I don't think children can legally own property until they're 18 anyway. But like I say, there are tax implications, which means that it may not be possible to do that as well. So that just needs considering beforehand. And also, do you set up a partnership? You know, rather than owning the property just in your name, can you own it jointly with your children maybe, or possibly with a trust or something like that? If you've already got a property, you can consider gifting the property or shares in a property company. Again, we need to consider the capital gains tax and stamp duty land tax implications of that. If you gift it directly to the children or the next generation, then there's no inheritance tax payable at the date of making the gift. However, the value is still effectively caught within your estate for inheritance tax purposes for the next 7 years. So you only make a full inheritance tax saving after 7 years has passed. And again, we need to think about that capital gains tax. Does that create a capital gains tax liability if you gift the property directly to your children? Generally, with most clients that I discuss this with, or always, we need to think about whether there's any risk of giving that value to your children. So if you give a property to your children, they own that property, and there is risk of the whole wealth being lost from the family if they get into financial or relationship difficulties. So that's another non-tax factor that needs to be considered if you're looking at gifting properties. Something else people look at is maybe gifting properties into trust. The benefit of gifting the property into trust is that it is possible to claim holdover relief on the value or on the gain. So it means that there can be no capital gains tax payable when moving a property into trust. And it also does add additional protection. So because the property is in the trust, it's not in the beneficiary's estate themselves. So if they do get in any financial or relationship difficulties, it's not an asset that can be accessible under them. So there is more protection. I don't think it's complete protection, but there's a lot more protection than gifting the property directly to your chosen beneficiary. The only thing to be aware of when placing property into trust, you can only gift up to £325,000 into trust. That's the maximum amount, which is your available in your rate band. If you gift more than that into trust, there is a lifetime inheritance tax charge at 20%. So that's something else that just needs to be thought about if you're looking at this route. The only other thing I would say is if you're gifting property, then just be aware that it's a true gift, a permanent gift, and it means that you can't benefit from the capital or the income that's paid from that property. So you have to be comfortable that you can afford to gift away that property and not receive the rental profits from it. Otherwise, it's not a true gift. for inheritance tax purposes, and it doesn't work for tax purposes. If you do need the income and you can't afford to gift the property, something else which I've seen work well for some is that you can effectively sell the property to your children. And what this means is that you sell the property to the children. There may be capital gains tax and stamp duty land tax to pay. But if those amounts are small, it may be worthwhile doing that. And effectively, what you do is the children or the next generation will pay the income tax on the rental profits. They will receive the rental profits, but that the profits can be used to repay the loan that they owe you for buying the property, which still provides the transferor some level of income. Effectively, they're spending capital value of the property rather than income. So that can also work quite well because it does diminish the value of their estate and therefore their tax liability over time. Another option is that you could look to sell properties. Again, there would be tax payable on that, capital gains tax payable potentially. But then with the cash, you've got more flexibility to gift it and wait 7 years for the value to fall outside of your estate. Or there are inheritance tax friendly investments that if you've got an IFA, they will be able to help you and select the suitable investment. But the idea is that certain investments that qualify for business property relief, they are effectively tax-free after you've held them for 2 years. So you can reduce your inheritance tax position by looking at these certain type of investments. And then finally, freezer shares. So this is if you've got a property company. Effectively, what we're looking at here is creating 2 classes of shares. The A class of share or first class of share fixes the capital value of the company at the minute. So if you've got a property company which is worth £1 million, then you would hold all of those shares and that entitles you to the first £1 million on the sale or winding up of the company. You then create a growth share or B shares, which entitle the company to any growth in value of that business over time. So as the properties increase in value, or as the rental profits are reinvested into the business, the company will increase in value. And these growth shares you can pass on to a trust or the next generation or whoever it might be. And the idea is they are the shares that will grow in value and it stops your inheritance tax position getting worse. We've run the numbers through for a few clients on that. In actual fact, the growth of the company can be quite surprising in terms of how much tax that does attract. So if you have got a property company and it is all in your name, that might be a viable option to mitigate part of your inheritance tax liability going forward. So there's just a few options there, and it's something that we need to look at on a case-by-case basis, like I said, but there are things that you can do.
All right, thanks, Kirk. So I'll look at this quite quickly because it's currently expected to be abolished from April 2025, although, of course, what Labour does, who knows? But I can't really see them bring this back in. But Kirk mentioned it earlier that furnished holiday lettings are their own class of rental properties, which do give additional tax reliefs to people if you can meet the stringent conditions. Just quickly, the stringent conditions are that the holiday let is available for 210 days in a year. It's actually let for 105 days a year. And the pattern of the lets, i.e., it's basically short-term lets. I think if you know about it, you know about it. If you don't know about it, it's probably a little bit too late. But furnished holiday lettings, you can claim capital gains tax relief for traders, as Kirk was just talking about. You are entitled to plant and machinery capital allowances. And quite a good one is your profits count as earnings for pension purposes. But as I say, this is likely all to be gone in the next few months. But something to keep in mind if you have got them and they are going to go. So it will have a slight difference on you.
I suppose the point there as well is that if you have got a furnished holiday let, and it does qualify for those reliefs, it may be worth thinking about whether you want to benefit from them before April 2025, because after that date, they will be treated as a normal residential property, which may have higher capital gains tax charges on them. So it's worth looking at that to see whether it depends on what your long-term ambitions are or plans are for that business as well. So yeah, just like you say, it's going to be abolished from April 25. So just give that some thought. Okay.
Other useful property tax reliefs. You've got what's known as the property allowance, which is very, very good if you don't have very many expenses. Basically, it allows you to subtract £1,000 of relief against your rental income when calculating your taxable rental property. So yeah, as I say, very, very good if you don't have, you've got a very good tenant. It doesn't need much cost spent on that rental property. You can automatically have £1,000, no questions asked, against your income. If you do have higher expenses on your rental property, then you can claim allowable expenses. This is instead of claiming the property allowance and not in addition to it. So you can claim stuff like repairs, council tax, water, electricity, anything that is for the purpose of renting out that property, including that time that it is between tenants. You know, often a tenant leaves and you've got to do some work and you've got to pay the rates between that period. So they're all allowable to subtract from your income to create your taxable profits. Replacement relief is, say, if you've got a sofa and it needs replacing, then you can have that cost of that sofa as an expense against your rental income, again, to reduce your taxable profits. The problem is this is quite a tight law, and I believe it's in the revenue's guidance that if you had a two-seater sofa and you replaced it with a three-seater sofa, because you've added an extra seat, it doesn't qualify for replacement relief. But obviously we've got to be a bit, commercial there. And then a further potential tax relief is rent a room. This is when you physically rent a room out of your own residential property. And the rules are very tight here, but if you do tick the boxes, you can earn up to a tax-free threshold of 7.5 grand a year. So if you're doing that, it's certainly worth looking into.
Thank you. And then just before we break for some questions, so just finally, family property planning is just a quick one on rental income. Again, it's a common question we get asked or we suggest to clients in terms of how they should own properties. And it's just being aware of these rules to make sure ultimately that rental income is being allocated and therefore taxed in the most favorable way. So typically we want to try and make sure that rental income is taxed on those that have lower levels of income. So it's taxed at the basic rate rather than the higher rate, for example. For spouses, income is automatically split equally if the property is held jointly. And what I mean by that is if the property is held 99% by one spouse and 1% by the other spouse, the rental income is automatically split 50-50 despite the uneven ownership of the property. What we can do is if we want to be taxed on the actual ownership, so we want to be taxed on 99%, 1%, we can complete a form or a declaration called Form 17, which notifies HMRC that we want to revert from the standard 50-50 split to the actual split. So that's the rules for spouses. For non-spouses, the rule is also different. And the rules are that if you own property jointly, your rental profit is the amount you receive, not necessarily your ownership. So if you've got a property that you own maybe jointly with your child and they're at university, they've probably got no or little income. So you might only give them a small capital share in the property. So you might give them a 1% shareholding, but then, or ownership percentage. But then if they receive the bulk of the rental income, then they will be taxed on the amount they receive, which is hopefully at a lower rate than otherwise. But importantly, that you need to make sure that the owner, if it's your child, is at least 18 years old. Otherwise, the settlement legislation will kick in and will tax the parent on the full rental income in any case. So just an important one to consider again, when you've got a rental property, how can you own that so that it's working for you to minimize that tax liability? And that brings our webinar to a close. So just before we finish, do you want to run through the questions, Michael, that we've got?
Yeah, got a couple here. So is anyone excluded from MTD? That's a brilliant question. And yeah, one we've been asked for with VAT as well. Basically, it's very hard to be excluded from from MTD. They have announced that foster carers, for some reason, don't have to be mandated if you've got rental properties. In addition, people that don't have an NI number. And it's also if your religion doesn't allow you to do it, or if you're unable to basically get the internet because you live so far and remote and extreme, although that probably means you're not watching this webinar if that ticks your, that probably doesn't apply to you. They do suggest that if you are already excluded for MTD for VAT, then that will also carry across. But again, we'll have to keep our eye out for that one. I hope that answers that question. So we're looking to buy our first rental property. Should we set up a company? There we go, Kirk. That's one for you.
Okay. I think Michael sort of touched on this earlier. It's a difficult one because it's not a simple yes or no answer. I think, generally speaking, it wouldn't make sense to operate through a company if you don't plan for the property business to be sufficient enough in size. So if the plan is to build it so that you've got 5 or more rental properties, a company starts to make more sense because the cost of running the company is less than what the potential benefits are or the savings are. So I think that's one thing in terms of the size of the business. How long you're looking to hold the properties for? If it's going to be a short-term or relatively short-term investment, then it's probably better to hold it in your personal name rather than setting it up through a company. I think a company set up better for longer-term investments. Whether you need the income is an interesting one. So if you need the income from the rental property, there's more of a tax saving using a company if you're happy to roll the rental profits into the business, reinvest it back into the business. If you're relying on that rental income to supplement your income, if you need all of the rental income profits to supplement your income, then again, it sort of points more towards personal ownership maybe as well. So it depends on whether you're a higher rate taxpayer, in which case, if you're a high rate taxpayer and you don't need the rental profits, you're happy to reinvest it into the business. That's where the company really does come into its own. So that's a big saving there. So I think they're the kind of things that you're looking at really in terms of whether to go through the company or not. I suppose borrowing as well. Typically, we're finding that borrowing or mortgages in a company is more expensive than it is personally. But personally, you're restricted to 20% basic rate relief, whereas in a company, you get full corporation tax relief. So again, understanding your income levels and if there's borrowing on the properties has an impact on what the option is. So yeah, sorry to give you a bit of a vague answer. It wasn't a yes or a no, but it depends is the answer, I'm afraid. So we need to look at the whole picture on that one.
So it's all about your intention, isn't it, at the start? And I think that's very hard to nail down sometimes.
Yeah, absolutely.
And the revenue are making it far less attractive, I think, with tax rates to be a company as well, that kind of gap has shortened in recent years, doesn't it, Kurt?
Yeah.
Saving in a company compared to individual. And yeah, that's about it for our questions.
Perfect. Okay. Well, that does conclude our webinar today. If you've got any other questions or would like to discuss anything in more detail that we've covered today, or indeed anything else, then feel free to contact us. Our contact details are there on screen. So yeah, feel free to get into touch with either myself or Michael.
Mine spelt
Um,
wrong, but never mind.
um, and yeah, we will. This webinar is also being recorded, so if there's anything you want to catch up on and rewatch it again, look out for the recording of it, and it should be on our website in the next week or so. So thank you very much.
Thank you so much, guys.